A bull market is a liar. It whispers in your ear that you are a genius, that your hunches are brilliant, and that the money is easy. It convinces the man who has been right for 6 months that he can be right for 6 years. A bear market is the truth. It is a cold, hard reckoning that exposes speculation for what it is, the most fascinating and dangerous game in the world. It takes the easy money back with interest, and it does not care about your opinion, your research, or your hopes. It is a force of nature, a financial winter that freezes the unprepared. The lessons I learned about these cycles were paid for with millions of dollars, lost and won back again. They were documented for posterity in the book Reminiscences of a Stock Operator. If you wish to understand the terrain I am about to describe, the link in the description of this video is your map. Study it, because the rules I am giving you today are not theories. They are the laws of survival carved into the wall of my memory with the sharp edge of financial ruin. When the bull market dies, you must live by a different code. These are the 5 golden rules for surviving, and even profiting from, a bear market. The first rule is the most important and the most difficult for the human mind to accept. Cash is a position. In fact, in a bear market, it is the best position. The amateur speculator feels a constant itch to be in the market. He believes that if he is not holding a stock, he is not making money. This is a fatal delusion. In a bear market, your primary objective is not to make money. It is to not lose money. Capital preservation is the entire game. If you lose 50% of your capital, you must make a 100% return on the remaining half just to get back to where you started. The mathematics of loss are brutal. Sitting in cash is an active decision. It is the decision to protect your ammunition while the soldiers around you are firing theirs wildly into the darkness. I made my first $1 million by being right about the 1907 panic. But I would not have had the capital to make that bet if I had squandered it on foolish trades in the choppy, uncertain market that preceded the crash. For months, the line of least resistance was not clear. The leaders of the market, the big railroad and industrial stocks, had stopped making new highs. They would rally, but the rallies were weak. They would fall, and the selling felt heavy. I did not know for certain that a crash was coming, but I knew that the easy money was gone, so I waited. I sat on my hands in cash watching the ticker tape, what you now call your live price feed, for hours every day. My brokers thought I was idle. My friends offered me tips. I ignored them all. I was not idle. I was a hunter, waiting for the one perfect moment to strike. Holding cash is your shield. It protects your bankroll, but more importantly, it protects your mind. A man who is holding a losing position cannot think clearly. His judgment is clouded by hope, the most dangerous of all speculators' emotions. He hopes the market will turn. He prays for a rally. He reads the news looking for a reason to justify his mistake. The man in cash has no bias. He sees the market with perfect clarity. He is the general on the hill, watching the battle unfold, waiting for the enemy to make a fatal error. Your job in a bear market is to become that general. Sell your positions when the trend first shows signs of breaking down. Do not wait for confirmation that ruins you. Move to the safety of cash and wait. Patience is your greatest weapon when the world is panicking. The second rule governs how you must view any sign of strength in a falling market. Rallies are for selling. A bear market rally is one of the most deceptive and dangerous phenomena in the financial world. It is designed to do one thing: inflict the maximum amount of pain on the maximum number of people. After a steep decline, the market will suddenly surge upwards. The television pundits will declare the bottom is in. The hopeful amateurs, trained by the bull market to buy the dip, will rush back in, believing they are getting a bargain. They are not getting a bargain. They are providing the exit liquidity for the professionals. These rallies are fast, sharp, and violent. They feel real. But they are built on a foundation of sand. They are technical reactions, short covering by those who sold earlier, and nothing more. I saw this time and again. In the great crash of 1929, the market did not go straight down. There were ferocious rallies that convinced thousands that the worst was over. After the first major break, there was a rebound that recovered nearly 50% of the decline. The newspapers celebrated. The public breathed a sigh of relief and bought more stock. I did the opposite. I sold more. I increased my short positions. Why? Because I watched the tape, not the headlines. The volume on that rally was weak. The former market leaders, stocks like Anaconda Copper and U.S. Steel, failed to make new highs. They stalled at levels of previous resistance. The tape was telling me that the buying was not genuine. It was a convulsion, not a recovery. A modern trader must learn to see these green days not as a sign of hope, but as a golden opportunity. It is your chance to sell any remaining long positions at a better price, to cut a loss that you failed to cut earlier. It is your chance to initiate a short position, selling into strength as the amateurs are buying on hope. Never ever be tempted to buy into a bear market rally. It is like running back into a burning building because one room seems to have stopped smoking. The entire structure is compromised. The path of least resistance is down, and every rally is simply the market taking a breath before the next plunge. You must be disciplined. You must sell the rips, not buy the dips. This single change in mindset will separate you from the 90% who are guaranteed to be ruined by the bear. The third rule dictates when you should take your profits on a short position. Panic is for covering. This is the mirror image of the bull market rule to buy panic. As a short seller, your profit comes from the decline. The more fear, the more selling, the more money you make. This creates a difficult psychological paradox. The moment you are making the most money is the moment of greatest danger. When the market is in a free fall, when headlines are screaming about a crash, when there is true blood in the streets panic, that is when your short positions are at maximum profit. The temptation, driven by pure greed, is to hold on for every last dollar. You begin to imagine the stock going to zero. You feel invincible. This feeling is the signal that it is time to take your money off the table. You must cover your shorts and buy them back into the teeth of the panic. Why? Because panics do not last forever. A market climax, whether at the top or the bottom, is an emotional event. A selling climax or capitulation is when the last seller finally gives up. He is forced to sell, either by his broker making a margin call or by his own unbearable psychological pain. When the last seller has sold, there is no one left to sell, and the market must rally if only for a short time. Your job is not to predict the exact moment this will happen. It is to recognize the signs. In 1907, during my first great short campaign, the panic reached its crescendo when the brokerage houses began to fail. The very machinery of the market was breaking. The selling was no longer rational. It was a liquidation of everything at any price. That was my signal. I began to cover my shorts, buying back the shares I had sold at higher prices. I did not catch the absolute bottom of the panic. No one ever does, except a liar. But I captured the great central part of the move. I was told a story about the great speculator Baron Rothschild. He was asked how he made his fortune. He replied, "I never buy at the bottom, and I always sell too soon." This is the wisdom of a professional. You are not in the business of being perfectly right. You are in the business of making money. When you see a vertical drop on your charts, when the volume is 5 times its normal average, when the news is apocalyptic, that is not the time to get more bearish. That is the time to go to the bank. Cover your position, turn your paper profit into real cash, and move to the sidelines. The market will still be there tomorrow, but your profits might not be. The fourth rule is a direct assault on the intellect, which is often a speculator's greatest enemy. Ignore valuations. In a bear market, there is no such thing as a cheap stock. The academic will tell you that a company is undervalued because its price-to-earnings ratio is in the single digits, or because it is trading below its book value. This is a form of intellectual vanity that has no place in the real world of speculation. The market does not care about your spreadsheets or your discounted cash flow models. A stock is worth only what someone else is willing to pay for it, and in a bear market, they are willing to pay less tomorrow than they are today. Arguing with the tape is a fool's errand. I learned this lesson the hard way. I once held a position in a cotton company that I believed was fundamentally undervalued. The price kept declining, but my analysis told me I was right. I held on, confident that the market would eventually come to its senses. The market did not. I was forced to take a ruinous loss. From that day forward, I made a vow. I will never again argue with the tape. The price is the price. It is the final arbiter. A stock that has fallen from $100 to $50 is not a bargain. It is a stock in a downtrend, demonstrating profound weakness. There is no law that says it cannot go to 25 or to 10. In fact, the momentum suggests that is its most likely destination. Your job as a speculator is not to be a financial analyst. You are a student of mass psychology and momentum. You must accept that in a bear market, all the good news in the world will not stop a stock from going down. A company can report record earnings and the stock will still fall, because the general tide of the market is pulling everything out to sea. Do not look for bargains. Do not look for stocks that are holding up well. In a bear market, the leaders of the old bull market are often the stocks that fall the hardest. They are the most widely owned, and when the selling starts, everyone is running for the same narrow exit. Look only at the price action. Is it making lower highs and lower lows? Then the line of least resistance is down. Your valuation does not matter. The opinion of the analyst on television does not matter. Only the verdict of the tape matters. The fifth and final rule is the synthesis of all the others. Respect the momentum. The single greatest truth in speculation is that a market in motion tends to stay in motion. The most profitable trades are not made by fighting the trend, but by identifying it and riding it. In a bull market, the line of least resistance is upward. You buy stocks that are breaking out to new highs. In a bear market, the line of least resistance is downward. You must completely reverse your thinking. You sell stocks that are breaking down below key support levels. This is emotionally difficult for most people. It feels wrong to sell something that is already falling. It feels safer to buy something that is rising. But you are not in this game to feel safe. You are in it to be correct. And being correct means aligning yourself with the dominant force. Trying to pick the bottom of a bear market is one of the most common and destructive mistakes an amateur can make. He will see a stock down 70% and think it can't go any lower. This is not thinking. It is hoping. He's trying to be a hero, to catch the falling knife. Heroes in the market end up with nothing but scars. I never tried to pick the bottom. I always waited for the market to show me the bottom was in. How? A stock will put in a low, it will then rally, then it will decline again. If that second decline holds above the first low and then the price rises and breaks above the peak of the rally in between, that is the signal. That is the pivot point. The market itself is telling you that the character has changed. The pressure has shifted from selling to buying. Until you see that confirmation on the tape, you must assume the downtrend is still in force. Respect it. Do not fight it. You can stand aside in cash or you can join it by selling short, but you cannot stand in front of it. A bear market is a force of nature, like a river that has flooded its banks. You can get in a boat and row with the current, or you can stand on the shore and watch. But if you try to stand in the middle of the river and stop it, you will be swept away. Your job is not to command the market. It is to obey it. Listen to its message. And in a bear market, the message is simple. The path of least resistance is down. These 5 rules are not a magic formula for getting rich. They are a blueprint for survival. A bear market is a test of character, of discipline, and of emotional fortitude. It will strip away your ego and expose every weakness in your method. Most will fail this test. They will hold and hope. They will average down. They will buy the deceptive rallies, and they will be washed out of the game, left with nothing but regret. But if you can master these principles, if you can learn to sit in cash, to sell into strength, to cover into panic, to ignore the false promise of value, and to respect the awesome power of the trend, you will not only survive, you will emerge from the wreckage stronger, smarter, and with your capital intact. And when the winter finally ends and the new bull market begins, you will be one of the few with the resources and the wisdom to ride it to a fortune. That is the ultimate prize. Survival is victory.